When it comes to trading, what's the real difference between just gambling and being a real strategist? Well, it often boils down to this one super critical foundational concept. And today, we're going to break it all down. Okay, so here's a question for you. Sounds kind of like a riddle, right? How can you actually be profitable even when you're wrong more often than you're right? I mean, it sounds like it totally defies basic math, but this is the big puzzle every single successful trader has to figure out. And the answer? Well, it's not magic. It's actually a really simple but powerful principle. And that answer? It's something called the risk-reward ratio, or RRR for short. Now look, this isn't about having some magic crystal ball that predicts the future perfectly. No way. It's all about managing your potential outcomes. It's just a simple, calculated comparison. How much could you potentially win versus how much are you actually willing to lose on this one trade? All right. To make this super clear, let's use a classic example, one that a ton of traders use as a benchmark, a 1-to-3 ratio. Just remember that number. That simple ratio is the key to unlocking the real power of this whole idea.
And this chart, it shows that 1-to-3 ratio perfectly. Just look at those bars. For every single rupee you're willing to risk, that's the small bar, your potential downside, you're aiming to make 3 rupees in profit. That's that big reward bar right next to it. See? Your potential upside is literally 3 times your potential downside.
So this is it. This is the solution to that riddle from the beginning. Think about it. With a 1-to-3 ratio, just one single winning trade makes you 3 rupees. That one win completely wipes out the 1 rupee losses from 3 separate losing trades. And this shows you something so important. Your risk-reward ratio and your win rate are totally linked. The better your ratio, the less often you actually have to be right to make money. I mean, with this setup, you only need to be right about 26% of the time to start being profitable. How crazy is that?
Because let's be real, without a system, trading is just, an emotional roller coaster. You've got panic making you sell at the absolute worst moment, greed telling you to hold on way too long, and fear stopping you from grabbing great opportunities. It's just chaos. A system, though, that's your anchor in that storm.
Okay, so how do you actually do this? It really just comes down to 2 simple things you decide on ahead of time. First, you set what's called a stop loss. This is basically an automatic order that gets you out of the trade if the price drops to a certain point. It caps your loss. That's your risk. And second, you set a target level. This is the price where you'll take your profits. That's your reward. And the key part? You define both of these before you even get into the trade. And here's why that's so crucial. By setting these levels in advance, you take all that emotional guesswork right out of the equation. The decision is already made. You're not reacting to fear or greed when things get crazy. You're just executing the plan you already made. Simple as that.
All right, so a 1-to-3 ratio sounds pretty good, right? But is it some kind of universal magic number you can just use everywhere? Well, the short answer is nope. The right ratio really depends on what it is you're trading.
A good way to think about it is that different markets have different, personalities. You've got a super volatile market like crypto, right? It can have these massive price swings. So you might need a much higher reward ratio, maybe even 1-to-5, just to make that risk worth it. But then you have a more stable stock market. Here, a more modest ratio might work just fine. The whole key is adapting your tool to the environment you're in. So why does any of this really matter in the long run? Because using a good risk-reward ratio consistently isn't just about winning 1 or 2 trades. It's about building a real long-term edge. It's what protects your trading capital from those huge wipeout losses. It improves your performance over time, and maybe most importantly, it builds that crucial discipline you absolutely need to succeed for the long haul. I mean, this quote right here, it really says it all. For professional traders, this isn't some optional extra or a nice to have. It is a non-negotiable rule, period. Before even a single rupee is on the line, they know exactly what they could lose and what they're aiming to gain. That's the difference between planning and just hoping. So look, if there's one thing you take away from all this, let it be this. The risk-reward ratio is the absolute bedrock of a sustainable trading career. It's the framework that lets you survive the inevitable losses, manage your emotions, and ultimately find a way to be profitable over the long term. So this isn't just some abstract theory, It's a very practical question that you have to answer for yourself before you even think about clicking buy or sell, because knowing your ratio, that's the very first step to trading smarter.